Despite U.S. officials' intention to set a price cap on Russian oil, as well as Washington's harsh criticism of Saudi Arabia due to the OPEC Plus decision to cut oil production, oil prices have dropped to almost $90 per barrel. And it's all about the cartel's response to Western criticism. OPEC and its allies have slashed the oil demand forecast in the face of a looming recession, not only in Europe and the United States, but also around the world. However, a further price decline is unlikely. After all, even a number of White House advisors realize that a price cap on Russian oil may lead to more severe energy shortages and, accordingly, a sharp rise in the prices. Most Western banks keep the oil price forecast for the end of this year at $110 per barrel. But we see that Brent crude oil futures resumed the downward move following short-lived stagnation. As a result, the quote broke through the variable pivot point of 93.20. Since the beginning of the trading week, the asset has lost 7% after bouncing off the resistance level of $100 per barrel. At the moment, the 90 mark acts as support level. Meanwhile, gold has been holding steady so far. However, the situation will most likely change when the United States reports data on inflation. Moreover, yesterday's statistics on producer prices signaled at least an extremely modest slowdown in consumer price growth. In the worst-case scenario, US inflation may remain intact. If these fears are confirmed, the Fed will not temper the pace of coming interest rate hikes. This, in turn, will spur a rally in the US dollar, thus dragging the yellow metal further down to the level of $1,660 per troy ounce. Gold prices will advance only in a case US consumer prices fall significantly. The signal of an uptrend will be confirmed after the price rises above the mark of $1,685. As for the Russian currency, the currency market continues to address previously formed imbalances, with the dollar heading towards 63 rubles. However, even rising geopolitical tensions are hampering the stabilization process. In particular, the United States is ramping up efforts to place a price cap on Russian oil. Thus, U.S. Treasury Secretary Janet Yellen said that the cap in the $60 a barrel range would likely be sufficient to reduce Moscow's energy revenues while allowing profitable production. Although an increasing number of experts say that this step will only lead to energy shortages and a surge in oil prices. The prospect of new harsh sanctions limits the ruble's upside potential, even despite its local oversold conditions. And in this situation, the most likely trading scenario suggests a sideways movement in the range of 62 to 63 rubles per dollar. And that's all for now. We continue to learn developments on financial markets. We wish you profitable deals and see you on our channel with a new video in a couple of hours.